There's all this talk about 50-year mortgages, and on the surface, maybe it sounds like a good idea. You know that the payment on a 15-year mortgage is more than the payment on a 30-year mortgage, and you know that a lot of people are struggling and housing doesn't really seem to be affordable for a lot of people. Maybe a 50-year mortgage payment would be cheaper than a 30-year, right? But what if I told you that it doesn't make mathematical sense at all, and that taking on a 50-year mortgage could be one of the worst financial decisions that you could ever make? In this video, I'm going to teach you about mortgages. I'm going to show you exactly how they work, and at the end, you will fully understand why a 50-year mortgage is just awful. I'm Rebecca. My husband and I have been buying and selling real estate for over 10 years. We've bought, flipped, rented out, renovated, and owned probably over 20 properties. And I'm going to show you why I would never do a 50-year mortgage. But first, let's talk about mortgages. I've realized that a lot of people don't have a good understanding of how mortgages work. And once you see how the math works on mortgages, one, it'll kind of in general feel like a stomach punch if you've never seen them mathematically played out before. But two, after seeing how they work, you will never, ever want to take out a 50-year mortgage or recommend anyone take one out ever. To show you, I'm going to go online and I'm just going to go to a regular mortgage calculator. I'm just on mortgagecalculator.org. For easy math, I'm going to do a $500,000 home and 5% down. So your loan amount is $475,000. For interest rate, let's click over. Today's 30-year mortgage rate is 6.41%, and the 15-year interest rate is 5.78%. This is how much money the bank charges you to use their money. So if you want to borrow and tie up their money for 15 years, the interest rate is 5.78%. If you want to borrow and tie up their money for 30 years, the rate's a little bit higher at 6.41%. The longer you tie up their money, the more money that they need to make off of you to compensate them for tying up their money for that long. It makes sense. First, I'm going to show you how the math works on a 15-year mortgage. So the interest rate was 5.78. We're going to do 15 years. And just to make it easy, I'm going to leave the property tax, PMI, insurance, HOA, all that kind of stuff at zero. So when we calculate what the mortgage payment would be, your monthly payment would be $3,952 to buy this $500,000 house on a 15-year loan. Have you ever looked at an amortization table? It shows you how your loan changes as the loan progresses. Did you know that at the beginning, see this light blue color? The light blue color is your interest. The dark blue color is your principal. That's like what you owe on your house. So let's scroll down to the amortization table. So month one, $1,600 of your payment is going to principal, which is paying down the amount that you owe on the house. But $2,200 of it is going to interest. And every month thereafter, the interest number gets a little bit less, a little bit less, a little bit less, and your principal number gets a little bit more, a little bit more, a little bit more. And then about 7 years into the life of this loan, it kind of flip-flops to where you're actually paying more towards the principal than you are towards interest. Over the course of this 15-year loan, you have paid a total of $236,000 to the bank in interest. That's the cost of doing business with the bank to tie up their money for 15 years. At the end of this loan, your total payments that you've paid over $700,000 for this $500,000 house. Whew. Did you guys know that? Okay, let's do it again, but let's do it with a 30-year. So the interest rate changes. It goes up a little bit because you have to pay them more to tie up their money for longer. The loan term is 30. When we calculate this now your payment is down to $2,974. So you've saved about $1,000 a month by doing a 30-year mortgage versus a 15. So people are like, whoa, I just saved a ton of money. But let's keep going. Let's look at all the other numbers too. Let's look at how much the bank made off of you. Now, at your amortization table, the first month, only $436 goes to principal, and $2,500 of your payment is interest. And then, same thing, every month, your interest payment gets a little bit less, a little bit less, a little bit less, and your principal goes a little bit more, a little bit more, a little bit more. So on your 30-year loan, it's not until about 20 years in that your payments start paying more towards principal than towards the interest. So over the life of your loan, you've paid the bank $595,000 just in interest. Just that's your cost of borrowing the bank's money for 30 years. So in total, now for this $500,000 house, you've paid over $1 million. You've paid more in interest than you even have for your house. Did you know that people are paying more in interest than they're actually paying for their house? It's crazy, right? The banks love it when you sign up for a 30-year mortgage, and this is exactly why they love that. So then most people kind of naturally think, okay, well, if I saved $1,000 a month by doing a 30-year loan, maybe I would save another $700 a month or something, $800, $900 a month by doing a 50-year loan. So let's look at the math. So same exact numbers, but remember your interest rate has to go up a little bit more if you're doing a 50-year loan. The difference between the 15 and the 30-year was about 0.75%. So let's be conservative. Let's just make it go up 0.5%. Let's do 6.9. And we're stretching out the loan term for 50 years. Check this out. Same exact house, same everything. Now your monthly payment is $2,800. So you saved $100, $125. That's it. So wait a second. That can't be right? We were supposed to save a lot of money, and this was supposed to be much more affordable for us to do a 50-year mortgage. But I'm only saving less than $150 a month by doing a 50-year mortgage. But now let's keep scrolling down. Now, when you go to the amortization table, month one, only $90 of your payment goes towards actually paying down your house. $2,700 of that is only to interest. And it stays that way. You don't even pay more than $100 a month until you're almost 2 years into your loan. I mean, you are barely making progress paying down the principal of this loan for a long, long time. Look at our graph up here. It is 2066. So you're about 40 years into this 50-year loan before you start actually making more payments towards your principal than your interest. All right, let's go down here. Now, over the life of your 50-year loan, you've paid $1.2 million just in interest to the bank. And your total payments, what you've paid total for your $500,000 house, is almost $1.7 million. So what did you give up by saving $125, $150 a month? You're paying a lot more in interest and a lot more in total payments. So do you see how this math works? Once you see these numbers and see the charts, it becomes crystal clear that a 50-year mortgage, the math just doesn't work. It's insane. And really, the amount of interest that you pay on a 30-year loan is really kind of crazy too, mathematically speaking. And to be fair, I didn't even take into account PMI. If you don't know what PMI is, it's the private mortgage insurance that you have to pay if you put less than a 20% down payment down. So that would be several hundred more dollars per month that you would have to pay. So your payment would be even higher. So would a 50-year mortgage make housing more affordable? I don't think so. The math doesn't show it at all. So what do we do? What can we learn from this video? Well, the most important part is just understanding how loans work, understanding amortization tables and how the interest rates work. And once you understand that, you can take specific steps to try to not pay as much interest to the banks. The goal is not to get the longest loan term possible. That's how the middle and low class people just end up digging deep holes for themselves that they feel like they can never dig out of. My goal is to use real estate and investments to grow my net worth and grow my asset portfolio. I do utilize bank loans for some of them, but here's what I do. Let's go back to the calculator, but I'm going to use I'm going to use a mortgage calculator that lets you add in additional payments. Okay, so on Bankrate, you can add in additional mortgage payments and calculate it that way. So I'm going to do our mortgage amount was $475,000 and our interest rate was 6.41. Okay, so if you can even just add $100 more a month to your monthly payment, did you know that that $100 only goes towards paying down the principal? It does not go to your interest, and it makes such a big difference. If you can just add $100 more to your payment, you then just shortened your payment term, your mortgage repayment by 2 years and 8 months, and you've saved over $63,000 of interest. That's big. That's a lot. What if you bumped it up to $250 extra per month? Just by doing that, you've shortened your mortgage repayment term by 5 years and 9 months, and you've saved over $130,000 of total money paid. That's golden. This is the key here. We want to limit the amount of money and the amount of interest that we're paying to the bank, and this right here is how you do it. You do additional monthly payments that go to the principal only. What if you're doing really well and you can add an extra $1,000 a month to your payment? Okay, now you've basically cut your mortgage term in half and you've saved over $300,000. Knowledge is key here, and understanding how the numbers work is so important. And once you build your knowledge and understand, I recommend you just go online to these calculators and play with the numbers, see what works with your family's budget, and play around with the numbers. Once you have the numbers right in front of you, you can make the wisest decision for your family's future. If this video helped you understand mortgages better, hit the like button. Leave a comment if you make additional payments on your mortgage and when and why you started doing that. And if you want to continue to build knowledge and learn more about money, investing, and business, hit the subscribe button. Welcome to Knowledge BILd. I hope this helped you.